I came out while at Deloitte. The feeling I got from everyone was love and admiration. I came out while at Deloitte. The feeling I got from everyone was love and admiration.
Recording in progress.
Good morning and a warm welcome to you to our webinar on the 2023 Finance Act. We're thrilled to have you join us today for this insightful session. Before we dive into the rich contents that our distinguished speakers have prepared for you, allow me to set the agenda and ground rules for this webinar. Firstly, we will commence with the opening remarks where our Yomi Olubenro, who is our West Africa tax leader, will briefly provide the general context for discussions that will follow. Following his opening remarks, we will move on to presentation of key changes in the Finance Act. And in this regard, our expert speakers will delve into the changes and provide valuable insights to help you grasp the implications for your businesses. The presentation will serve as a foundation for the subsequent panel discussions that we would have later. The panel session will feature distinguished industry experts who will share their insights and experiences on the impact of Finance Act 2023 on their respective businesses. Throughout the webinar, we encourage all the participants to use the Q&A box for all the questions that you may have. We have our team of professionals on standby to provide answers to your questions. Before further ado, I would like to introduce our West Africa tax leader, Yomi Olubenro, who will come on board now to give us his opening remarks. Thank you very much.
Right. Thank you so very much, Tolu, and good morning, distinguished participants on this webinar this morning. We're delighted to have you, particularly delighted that we could have, as many of you as we already have on the call, join us right, on top of the hour. This is a webinar on the Finance Act 2023, and it's, perhaps one of the most significant developments, within the tax space in the past couple of weeks, if you like. The tax environment has become even more dynamic, than we've seen. And if we go by the series of news and development we've had in the space, over the last 2-3 months, I think we can't agree less. And when these changes happen, whether by way of Finance Act, executive orders like the one we had yesterday, or different kind of fiscal policy interventions and measures, they come with the burden of compliance, the need to know, and the need to ensure that we are adequately, capacitated to educate, the business interests that we all represent. Many of us here are, charged with the compliance obligation within our respective businesses. And so the C-suite, the CEO, the board, they are looking up to most of us on this call to be able to provide the insight and the direction into what's in need for the business. So that's why we're having this conversation today. We know that this is a live show. It's planned for 2 hours. We can hold you down for 3 days, Hello, can you just confirm that you could hear me? I had a momentary interruption.
We can hear you now.
Okay, so I don't know where you, okay, thank you. I can see the thumbs up. So I don't know where I lost you or you lost me. So I was explaining that the essence of this conversation is to be able to get, those of us who are charged with the burden of, compliance within our respective businesses, get us acquainted with all that we need to be able to provide the insights that we need session for us today. I'm not going to steal the thunder of the panel moderator, because she will do good justice to that. But just to let you know, as you'll have seen in the flyer, that we are very strong resource people within the banking sector, within the oil and gas sector, within
Recording in progress.
It seems I'm having a little bit of interruption. Hello, can you hear me now? Okay, if at the back end, the IT are trying to, maybe they try to grant some admin right to me. So I'm not making a presentation, so you can just allow me do the 2 minutes intro so we don't waste too much time on the call. So just a little bit of intro, confirm that you can hear me back. I saw some thumbs up, some couple of minutes earlier on. Just some thumbs up to be, yeah, okay, beautiful, thank you. All right, so the final act, as you know, that was signed on the 28th of May, just the penultimate night to President Buhari's end of tenure, impacted just about all of the tax legislations that we use quite frequently within the country. There are 11 of them that were impacted. And there are 31 provisions, within that Finance Act 2023. So meaning that there are quite a lot of changes that, were brought about by the Finance Act. Some of the sections have several subsections. So even though it looks rather compact, but it came with some significant changes to the fiscal landscape. And so we know that over a 2-hour session, it may be impossible for us to do justice to all of it, but we will ensure that the key changes that you need to be aware of will be touched. And we've tried to group this across some common themes, right, to make it easy for us to be able to digest. Virtually every industry and every sector has one thing or the other that impacts them. And so what we've done is to group the conversation into 3. So we will have about 7 minutes to 10 minutes or thereabouts of 3 of my colleagues will come on to just provide an initial overview of the key changes from an indirect tax perspective, some changes from a direct tax, and then the rest of the changes, that touches on other fiscal legislations, we also be touched. And then once they are done with that brief overview, we will then delve into the meat of the conversation itself when we're going to break into a panel. The group head, strategic tax and compliance, Dangote, will be on that panel. DVP Finance, Airson and Gas, and of course, Dr. Mukhtar, Zenith Bank CFO will be on that panel, and with an internal subject matter expert from Deloitte as well. So I just want to, again, welcome you to this webinar. It promises to be very insightful. If perhaps you want to get a little more into, every line of the changes that may not have been touched in the course of the session, we do have a newsletter that was released just after the Finance Act was released to the public. The technical team will, I believe, will help to put a link on the chat box in case you haven't gotten a copy of that Finance Act newsletter, because it will help you to read a lot more and probably prepare you for the kind of question or conversations you're going to have. So the speakers are warming up to be able to talk to you, and I will just yield the floor at this point to the first speaker, that will be Chijioke Odo. take us briefly into all of the changes touching the indirect tax, and he will pass the baton to the rest of the colleagues as the conversation continues. Thank you so much. Enjoy the session. Thank you.
Thank you, thank you so much, Yomi. I've been warming up, eagerly waiting to hit the road. Good morning again. Good morning again, ladies and gentlemen. I'm sure it won't surprise you that we are starting with indirect tax, which these days have become the new direct tax. I mean, essentially because of how it's able to provide some certainty in terms of tax revenues for governments, because it's a first line charge on activities in every country. So there are 3 laws of the 11 that Yomi talked about. There are 3 laws that have an indirect tax impact. Okay, so the first one is the Value-Added Tax Act. Second one is the Customs Excise Tariff Consolidation Act, and the third one is the Stamp Duties Act. We will start with the Value-Added Tax Act. So there are 4 of them. Okay, so the first change has to do with payment of VAT on the 14th. Presently, when you file your returns, you can as well make your VAT payments on the 20th, on the 21st of the month, following the month of transaction. Now, what the Finance Act has done is to say, look, for businesses that have been appointed by FIRS, so we're talking about banks, telecommunications companies, non-resident companies who have been appointed as VAT collection agents, Finance Act 2023 has said, look, we want you to remit by the 14th of the month following the month of transaction, essentially a week before the filing deadline. Now, what are the key considerations for businesses? This just essentially means that from an administrative perspective, do you want to wait? Do you want to pay by the 14th and file by the 21st? Or do you want to file and pay by the 14th? So these are conversations you need to have internally. The second change has to do with the definition of buildings. Remember, Finance Act 2020 removed interest in building from the scope of VAT. At that time, building had a definition that included things like radio and TV masts, transmission lines, towers, and the likes. Now, the government has sat back and said, we don't think these things should be VAT exempt. And so therefore, we will redefine the meaning of building, to exclude these items. This just means that from 1st of September, when we expect that the Finance Act Finance Act 2023 will enter into force, these items will be subject to VAT. So from that time, please, you need to check what you've been doing and ensure that you make the required amendments. The third one has to do with, and this is a very interesting one, non-resident digital suppliers as collection agents. To remember, effective 1st of January 2022, non-resident companies who supply services via a digital platform are required to charge VAT, collect that VAT, and remit it to the Federal Inland Revenue Service. Now, what Finance Act 2023 has said now is, in addition to that, we expect that non-resident companies who supply goods through a digital platform are also supposed to charge that VAT, collect that VAT, and remit it to the Federal Inland Revenue Service. 2 things quickly jump out, okay, as a taxpayer. The first one is that the federal government deems a non-resident company more effective at collecting VAT than the Nigerian Customs Service, who are naturally at the border and should have visibility of the goods that are coming into the country and should be able to effectively control and collect the VAT and remit it. The second one is, what happens when a non-resident company who supplies these goods by a digital platform, effectively the big market players, okay, have issued you a customer in Nigeria a VAT invoice. Of course, the actual cost of the good is there, and of course, estimated charges, import charges have been issued to you, and of course, there is a VAT charge on that invoice. Now, what happens when the goods finally get into the country, and the Nigerian Customs Service has re-estimated what the actual amount of not just the value of the good, but also all these import levies. Now, from a reconciliation perspective, what happens? So for us, we think that as taxpayers, key consideration will be to engage the Federal Inland Revenue Service to ensure that they provide clarification and there is a proper handshake between the Nigerian Customs Service and FRS. For taxpayers that understand the current terrain around importing goods into the country, the last thing that businesses need now is another bottleneck that have to do with reconciliation of VAT. The fourth change has to do with artificial transactions. Now, before now, from a transfer pricing perspective, we typically ensure that our prices are at arm's length for the purpose of income tax, from an income tax standpoint. So where there are adjustments, the FRS will typically want to make those adjustments, your income tax computations to ensure that they collect the right amount of taxes on your profits. Now, Finance Act is saying we're going to extend that conversation to the VAT sphere to say, look, we will not just be looking at things that also impact profit, but from an activity perspective, once there are transactions, related party transactions, we also intend to check to see if those transactions are arm's length, okay, that they are not artificial. And where we think that they are, we will make those adjustments and any VAT consequences will have to be remitted. So we'll go to the Customs Excise Tariff Consolidation Act. The first change here has to do with excise duties on services. Now, it's important to clarify that there are currently no excise duties on services. What Finance Act has said is we have developed a framework that would allow the president to impose excise duty on services, okay? Just like the former president did on telecommunications services. Now, for a taxpayer, what this means is that, look, there could come a time when there could be excise duties on services. So you need to begin to engage the government to ensure that the right services are subject to excise duty. The next one has to do with introduction of new import levy. Again, this is not an immediate impact, but could be even as we speak. So the thing here is it says 0.5% import levy on eligible imports from outside Africa. Now, what constitutes eligible imports has not been defined. So this means that the government could very well today issue maybe an EO to say these are the eligible imports for which we will collect this 0.5% import levy. Two things that taxpayers need to do. Of course, again, engagement with the government to ensure that the goods that are eligible are truly reflective of the current economic landscape. And two, from a duty perspective and of course procurement and how we try to ensure that our supply chains are effective, we need to start looking at where we procure goods from. So if there's an extra charge from importing goods into Africa, we begin to start looking at our sourcing. Okay, can we begin to adjust our sourcing where we can begin to get critical materials from Africa? Not just because of this 0.5%, but also need to look at the AFCFTA, for instance, okay, and all the incentives that will come as well. Okay. The third one is a structural change within for the Tariff Review Board, and I will not spend so much time there. The next law that was amended is the Stamp Duties Act. Again, this is just structural around how the electronic money transfer levy is going to be shared. Previously, it was just between the federal government and the state government, but now we want also the local governments to also partake, just similar to how we have it in the Value Added Tax Act. So I will stop here, anchor here, and pass on to my colleague Funsho, who will take us through some of the changes in direct tax.
All right, thank you, CJ. I will continue the conversation by discussing the changes impacting the Companies Income Tax Act and the Petroleum Profit Tax Act. So I will take the changes impacting Companies Income Tax Act before those impacting the Petroleum Profit Tax Act. Okay, so the first change under the Companies Income Tax Act has to do with the tax returns filing requirements for international shipping companies and airline companies. You all will recall that recently the FIRS issued assessment notices to international petroleum shipping companies. These may be connected to changes introduced to the requirements for filing of tax returns by these companies. As you would expect, international shipping companies, like every other company in Nigeria, carrying out business in Nigeria, are required to submit a separate financial statement of their Nigerian operations along with their annual tax returns. right? So, but based on the Finance Act, international shipping companies who do not have actual financial statements will now be required to submit a gross revenue statement of their Nigerian operations. However, this statement, that's the gross, speaking to the gross revenue statement now, must be certified by an external auditor, like you would ordinarily audit your financial statements at the end of the accounting period. And then this, in addition to that, the accounts must be signed off by one of the directors of the company. All right, so shipping companies, so going forward, shipping companies will be required to produce their tax returns for the preceding year, as well as their tax clearance certificates when submitting applications for any permit or approval. So, so meaning that when they approach the NIMASA and NPA for any permit or approval, they'll be required to submit evidence of tax returns that have been filed in the previous year, and then tax clearance certificates showing their tax records for the last 3 years of operations in Nigeria. This was another change that has impacted the Companies Income Tax Act is the requirement to restrict capital allowance claims. So, but interestingly, with the Finance Act 2023, companies engaged in the upstream and midstream gas operations can now enjoy unrestricted capital allowance claims, right? So previously, only companies engaged in manufacturing and agricultural business were entitled to full capital allowance claim. You would agree that it's only fair that companies engaged in upstream and midstream gas operations also enjoy unrestricted capital allowance claims, as of course they are arguably involved in manufacturing activity, and their counterparts in the oil industry do not have such restrictions. I would move to the changes around investment allowance claims. Previously, only taxpayers were allowed to claim investment allowance on all additions to plant and equipment. So meaning if you invest in acquiring plants or equipment, then you would be allowed to claim investment allowance with an additional 10% uplift on the cost of acquisition of plant and equipment. So, but with Finance Act 2023, the claim of investment allowance is no longer permitted. So, so going forward, you will be able to enjoy this additional 10% investment allowance on additions to plant and equipment. And this also applies to plant and equipment acquired under lease arrangements. Interestingly, one that many people don't know about is an incentive that is available to hotel owners, right? So previously they were able to get exemption on foreign currency income that is derived from tourists. So, but this has been expunged from the tax law, and that incentive is no longer available. So I'll be moving to changes in the Petroleum Profit Tax Act. Generally, the changes made to the Petroleum Profit Tax Act were made to align the Petroleum Profit Tax Act to the Petroleum Industry Act that was passed into law in May 2021. Let me start with an interesting one, which is the decommissioning and abandonment cost. So previously, under the Petroleum Profit Tax Act, the Act did not make any provision for the treatment and deductibility of decommissioning and abandonment costs. Actually, in practice, what the FIRS would typically do is ask taxpayers to set up an escrow account where funds set aside for decommissioning and abandonment costs are kept. And when you're able to demonstrate this to the tax authority, they would allow you take deduction for those expenses. So, but with the Finance Act, companies impacted by these requirements are now required to set up a fund. So they need to set up a fund, and the fund will be approved by the Nigerian Upstream Regulatory Commission, which is the regulator, right? And the funds will also be monitored by the Nigerian Upstream Regulatory Commission. In addition to setting up this fund, they would also be required to provide a statement of account of the fund. Secondly, oil companies are yet to commence commercial production are now required to file tax returns within 8 months from the date of incorporation of their business. Or for those that have existed for more than 18 months, then they are required to file their own returns 5 months after the accounting year end. The reason why this is interesting is because previously in the Petroleum Profit Tax Act, there was no clear provisions around this, and there was ambiguity around the filing requirements for companies engaged in petroleum operations that are yet to commence commercial production. Previously, the regulatory body supervising companies engaged in the upstream petroleum industry was the Department for Petroleum Resources, BPR, as we all know it. So, but with the Petroleum Industry Act, the Department for Petroleum Resources was transformed into the Nigerian Upstream Regulatory Commission. So with the Finance Act 2023, it has now amended the commission. It has now incorporated the Nigerian Upstream Regulatory Commission in the PPTA. So thereby aligning the PPTA to the Petroleum Industry Act. So I won't spend so much on the penalties. So because generally penalties are quite similar. So, but what is important about this is to note that the penalty has increased significantly. So we have penalties increasing from as low as 10,000 naira to 10 million naira, and in some instances 2,000 naira to 2 million naira. So the penalties are quite steep, and it's important that the taxpayers take note of these penalties and avoid any situation that warrants payment of the penalties. Thank you for your attention. I will now pass the baton to my colleague, Karen.
Thank you very much, Funshaw. Okay, over the next couple of minutes, I will take us through 6 legislation that have changed under the Finance Act 2023. The first is the Capital Gain Tax Act. And under this, we have 3 amendments that have come in. As you all know, we've had a tussle around digital assets and what they mean. Are they currencies? Are they assets? But what we have seen with the Finance Act 2023 is that now digital assets have been classified as chargeable assets. In practical terms, it means that if you have any digital asset, which includes things like cryptocurrencies and blockchain assets, these will now be taxable under the Capital Gain Tax Act at a rate of 10%. I know that we've had that conversation around what we should be doing as a nation, but there's a clear message coming now from the government to say whatever streams of incomes are being generated by the disposal of this asset, we would now begin to charge them. So you need to take note of your activities around these to ensure that you're reporting appropriately and remitting the taxes whenever you make the disposals. Next is the deductibility of losses on disposal of chargeable assets. Before now, companies, when you make a disposal, individuals and taxable persons, whenever you make a disposal and there is a loss on that disposal of a chargeable asset, you will not be able to make a deduction for that loss. But thanks to Finance Act 2023, now whenever you make a loss on a disposal, within that year, within the first year that you make that loss, you'll be able to take a claim of that loss for the next 5 years following that year when that loss was incurred. It's a welcome development because then it allows that if you have a relief to claim for that, you would be able to, of course, enjoy that. Next we have is the rollover relief that has been introduced for the disposal of shares. Of course, the Finance Act brought in, Finance Act 2021 brought in the fact that we can now start to dispose, we can pay shares and pay capital gain tax on the disposal of shares. But it didn't also include this ability for you to extend whatever gain you have made on that disposal. But with the Finance Act 2023, any gain that you make within the year of disposal, provided that the sales proceed is reinvested within the purchase of shares of similar Nigerian companies, or even within the same company where you made that disposal, you will be able to roll over that gain. The practical reality is that you will not pay tax within that year that is that share is disposed until it is finally disposed and there is no further reinvestment on that particular disposal. Next, we'll go into the Tertiary Education Act, the Tertiary Education Trust Fund Establishment Act, TETFA. Simply, what government has done is to increase the revenues for this stream of taxation, and it's moved from the tax rate has moved from 2.5% to 3%. Over the last 4 years, it means that the tertiary education tax rate has increased or has moved by 150%. And it is simply a revenue generating action for the government, of course, to increase its ability to be able to meet the demands for governing the nation. The third legislation here, which I'll be touching on, is the Personal Income Tax Act. And interestingly, this is one section of the law which has been amended that affects every taxable individual. Section 33 of the Personal Income Tax Act, which deals with incentives, reliefs, has now been amended to reintroduce a relief on deferred annuity contracts that individuals go into. Prior to now, this provision was taken out. It was taken out in Finance Act 2021, but it has now been reintroduced. And it means that if you make any investment within a deferred annuity contract, which is supposed to be a long-term investment that allows you to save, if you have that kind of investment, you would not be taxed on it. However, there's also a restriction that has been brought in to curb abuse, which means that if you make any withdrawal within a 5-year period, whatever you withdraw, that to the proportion of what has been withdrawn will be taxed under the Personal Income Tax Act. The practical reality for employers and employees is that they need to track these investments. And of course, as an employee, you need to also let your employer know when you have made a withdrawal from that account, and so that you don't allow penalties and interest to accrue whenever the tax authorities come for a tax verification exercise. Next is we have other fiscal legislation which just empower the government to do more in terms of its revenue generating activities. And 3 fiscal legislations that have been amended include the Public Procurement Act, which has more or less increased the level of accountability and transparency that goes into the public procurement process. So as a public procuring entity of government, you would be required to ensure that there is a public procurement plan in place before any activity can go on. In addition, you should also ensure that you're following the guidelines that have been set by the Ministry of Finance and any other regulations that are issued by the Bureau of Public Procurement. In a similar law, which is the Corrupt Practices and Other Related Offences Act, there's an amendment to ensure that there's an alignment between the section that penalizes officials where they of course deviate from these procurement plans that are within the Public Procurement Act. There's just been an alignment to ensure that there's commensurate reprimand for them in case of a default. So for example, if for example a public procuring entity does not follow the guidelines, does not follow approved budgetary plans, but doesn't also follow the procurement plans of government, that particular defaulting officer will be exposed to a 3-year sentence or a 10 million naira fine upon conviction, of course. What we had in the law before is that if there was a default by an officer, you would still have the 3-year sentence, but you would then have 100,000 naira fine to that. So we've seen an increase in the fines that, of course, would be charged to that defaulting officer. I think mirroring both the Public Procurement Act and the Corrupt Practices and Other Related Offences Act is an alignment to ensure that there's transparency, there's accountability, and public officers are brought to book whenever there is a deviation from the law. And finally, on this section is that the Ministry of Finance Incorporated Act has also been amended. The Ministry of Finance Incorporated is an asset holding entity under the Ministry of Finance Incorporated is an asset holding entity under the Ministry of Finance. And it basically has the sole responsibility of solely managing the investments of the federal government. And what we have seen with the amendment of Section 3 of that act is that the president of the country now has the powers, upon the recommendation of the Minister of Finance, to, of course, appoint a governing council, an executive board, and a management team. With these combined powers of the president, we believe that the Ministry of Finance Incorporated would have the necessary backing, the necessary ability to then, of course, govern its activities under appropriate corporate governance rules. I'll stop here at this point and hand over to Ronke, who will take us through the panel sessions where a lot of the questions we have around these themes will be answered. Thank you very much for listening.
Thank you very much, Karen. And thank you very much, Chijioke and Funsho, for the insightful presentations. Up next is our panelist session. I'm sure we are all eager to hear from our seasoned panelists who are industry leaders in their various spheres. They will be sharing their views and insights on the Finance Act 2023. Our seasoned panelists, in no order of array, are Dr. Mrs. Titilayo Fowokon. She's the Group Head, Strategic Tax and Compliance, Dangote Industries Limited. Our next panelist is Dr. Mukhtar Adam. He is the Chief Financial Officer of Zenith Bank PLC. Also, we have Mr. Pascal Eva. He is the Deputy Vice President Finance, Oil and Gas Holdings. We also have Ashata Agboluaje. She's a partner in our tax and regulatory space. Thank you very much. We would like to say a very big thank you for all our panelists for taking time out of their busy schedule to join this session. We look forward to a very engaging session. Like earlier mentioned during the presentations, there are various changes in the Finance Act that will impact businesses, amongst which are the increase in the tertiary education tax rate from 2.5% to 3%. And the rate was barely increased like 2 years ago from about 2% to 2.5%. Now also in the Finance Act, the investment allowance incentive has also been removed. With the Finance Act, the investment allowance incentive has been removed. Companies operating the upstream and midstream gas operations can now claim their capital allowance fully. There are also stiffer penalties for non-compliance and a whole lot more. Dr. Titi, I would like to kick off the conversation with you. In 2 minutes, we'd just like to hear what are your general thoughts on the Finance Act 2023 as it pertains to the manufacturing sector. Thank you.
Thank you, Ronke. Thank you. I just want to say good morning to our distinguished participants and listeners this morning. The Finance Act generally would have a toll on the manufacturing sector. And I think one of the things that stood out to me is the impact it will have on our supply chain management. We now have to start looking beyond Africa, look within Africa, because now we're having some restriction as to doing anything outside Africa, and then you have this levy that is coming. That's one area that is going to be for us to start looking into within the industry. We have things around the capital gains on disposal of chargeable assets, which we now have to be looking at. Well, it's a plus for us anyway. We can now have an offset of the losses against the gains that we make, and then we are paying less in terms of cash flow for CGT purposes, and we have this 5-year limit. So that's going to be another one that we'll be looking at in the manufacturing arena. Then we now have things around this exclusion of some items from building for VAT, which I actually tried to ask a question. That means we have to now change the way we record our building expense, our QCE on building, to be able to separate these things and be able to treat them, especially with respect to VAT, the introduction that have been made to VAT. Now, things around the withdrawal of the investment allowance, because, you know, for manufacturing, our investment is in plant and machinery. And once this is withdrawn, you know what that means in terms of the tax attributes that we have to claim. So these are major. There are others. Intercompany is also there for us, where we relate with related companies in terms of our manufacturing products, we have to now start looking at how do we more tight monitoring as to this relationship. We already know there's TP, but now the VAT angle has now been formally introduced. So it has to be very, very under the supervision and scrutiny of the tax function. There is quite a lot. There's more work for the tax function from what is going on. Annual reviews are now done. So I think I should just leave it at that. Quite a lot for us to do now. Thank you, Ronke.
Thank you very much, Dr. Titi. Dr. Mukhtar, I'm sure the financial services sector is also not left out of the, of the Finance Act, the impact of the Finance Act in that sector. So we'd also just like to hear your general thoughts on the Finance Act and how it impacts the financial sector.
Good morning to the organizers. Good morning, participants. Good morning, fellow panelists. The finance sector is always very challenged, especially with the changes that are going through the Finance Act. We've seen how the finance sector was at the center of stamp duty and now EMTN levy and so on and so forth. So the Finance Act is now helping for the tax environment in Nigeria to be more responsive in a sense that every year we see changes coming through, and we also know that some of the changes go through because there are discussions between policymakers, practitioners, and operators. So it is making the tax laws more practical, and we are able to make a lot more input. The dynamism that is required of administering our tax is now being realized. So the current Finance Act, as we have it, looks good. It has touched on a lot of areas, but there are some other areas that needs to be looked at. The first panelist spoke about investment allowance that has been withdrawn. I think that is very significant to the manufacturing firm. For a country that is desperately looking for investment, especially in the real sector, that we want to produce most of what we consume, this is not the time to discourage investment in the real sector. Secondly, some of the manufacturers are customers for the banking sector. So the banking sector is very interested in the manufacturing firms making profits and staying alive. Otherwise, our loans go bad. So if they do not have such incentives, they cough out almost all their profit to pay tax. That reduces their cash flows and it reduces their ability to invest. That affects their ability to expand, and they will not be able to meet the demand for the market. So that is really very significant for the manufacturing firms. I also have my own issues relating to investment allowance as it affects the banking sector. Maybe I'll talk about it in due course, since this is the introduction. But generally, the dynamism is very interesting. Whatever the Act has not been able to address in 2023, as we continue discussion as a nation, we will address them in subsequent ones. That is what we have seen. Thank you.
Thank you very much, Dr. Mukhtar. I'm sure Dr. Titi will be quite happy with the last point of contribution you made with respect to the impact of investment allowance on manufacturing sectors and how it affects, going to affect their profitability. So I'm sure there's this interwoven connection, there's this connection between the banks and the manufacturing sector. Because for you, you're looking on how much more to make profit, and if your customers are not doing well, it will affect you. I really like the point you made, and I'm sure Dr. Titi is smiling also about that point, but we'll talk about it more in details as we proceed. And Mr. Pascal, I'm sure also that you also like to make comments around how this Finance Act has impacted the oil and gas sector, because it seems there's a bit more stiffer penalties that have been introduced for companies operating in the oil and gas sector. So we also just like to have your general overview on the Finance Act and how it impacts the oil and gas companies in the oil and gas sector. Thank you.
Thank you very much, and good morning to everyone on the call. Thanks to Deloitte for putting this together and opening up this platform for conversations. I think this is very important. The Finance Act 2023, it's one that is welcomed. There's a lot of changes that we've seen in the Act, particularly some very key changes in the oil and gas sector. I'll touch on some of them just because this is the intro. You talked about the stiffer penalties. The stiffer penalties are there. It does mean that we all have to comply with the Act, even when we do not agree in some instance. And we'll go into the details of that later. But the penalties are such that they are very steep, from 10,000 to 10 million to 20 million to 15 million. So compliance is the rule of the game. So we have to do that. But like Dr. Muta said, the dynamism is very good. We see key changes happening here and there. Those areas that were brought up in prior periods have been considered now. We also saw that this is pushing the discussion and the government is on top of it. We saw that the President Bola Ahmed Tinubu responded very well yesterday by signing the effective date of the Finance Act 2023. That's good. We also in the oil and gas we see the big issues around decommissioning. Decommissioning is a big element that has come and it's very good. Everyone is thinking globally about environmental impact of the operations and how remediation will be done at the end life of those operations. And the Finance Act have then made some very significant changes around the decommissioning and abandonment fund, how that will put together. So that is really good. We know that this will also strengthen the banking industry, although there are some conversations around how or where the funds will be domiciled, but clearly we have our thoughts on that, and then we'll speak to that as we get on. And for the capital allowance as well, very good and welcome development that happened in that space as well, because you will see that if you have the accessible profit, you can relieve you can relieve every the capital allowance in the early period. This is very important because it will improve the investment models. The present value factor impact will be very critical, and then this sends a very good signal to the international community that Nigeria is opening up and attracting investment. And so we expect that this will bring more good investors into the Nigerian state. And then it also gives even the operators the funds that are required for continuous investment. For those who understand the oil and gas very well, investment is very critical. You need to invest to protect your base production. You need to invest to find new oil. So that, as a country, we can meet our OPEC quota, we can meet our revenues. There's so much gap between the government revenues and what they eventually they show on performance. But, all of these key changes we expect will galvanize the economies to start running in the right direction, and then we'll bring the necessary changes that we expect. And then we also see that this will have a trickling down effect on all the other sectors of the economy. Remember that oil and gas is big in Nigeria. It's a reality. It's something we need to focus on. And then there are big quick wins that we can get from the oil and gas that will dovetail into the other sectors of the economy. And we see that this will happen with some of the changes that we see in the Finance Act 2023. Thank you.
Thank you very much, Mr. Pascal. And I'll come to Ashata. Ashata, as a tax practitioner who has clients across different sectors, what would you say are the major highlights for you in the Finance Act 2023? Because I'm sure you'd have had, a lot of clients come to you for clarifications or things that are, of giving them sleepless nights or, giving them some form of concern. What would you say are the major highlights for you in the Finance Act 2023?
Thank you very much, Ronke. To at least as my co-panelists have mentioned, having the Finance Act 2023 is a welcome development. Since its commencement in 2019, it's been coming and the consistency has been good. We thought we were going to miss it this year, but we are glad that we eventually have it because over the years, it's helped with clarification of certain issues, brought about incentives, imposed new taxes, raised taxes, but at least there's been a fine blend over the years. There's also been improvements over the years in the way it's been drafted. So over the years, there's been issue around the transitioning and the commencement, amongst other things. So this year, they tried to put the commencement there, but there are still issues that still need to be addressed. For example, the transitioning provisions. These should ideally be put in the act itself rather than leaving it to the administrators because there are substantive issues. You mentioned increment and tertiary education tax earlier. So whether the relevant accounts that it will be applicable to should actually be stated, ideally be stated in the law and not be left to tax authorities where taxpayers would claim, oh, tax authorities circular do not have force of law, amongst other things. If these are substantive issues, they should ideally be stated in the law. So for me, the highlights of the act and areas that we have seen that are generating issues across board are one, the inclusion of digital assets as the chargeable assets and the deduction of capital loss, which is a welcome development. We also have issues around the TCC, tax clearance certificates and filings for operators, international and non-resident operators in the transport sector, so shipping and airline cargos. So the filing of that, and up until yesterday, when we heard about the executive orders from the president, there's also been a lot of clamor around the excise on services and telecommunication services. So these are big ones. The other ones that my co-panelists have mentioned around investment allowances, how it impacts other sectors, the oil and gas sectors are key indicators. To go back on the excise. So a key critical aspect has been what constitutes telecommunication services, because there's a wide spectrum. So there are the MNOs, which is the network operators. There are other players in the industry that are concerned with are they covered or are they not covered? Would you cover all the value-added service providers or all other companies within the entire telecommunications landscape? So these are major considerations that have come to play in this regard.
Thank you very much, Ashata. And based on what you said, I would like to ask you a further question. We understand yesterday the president signed some executive orders, which includes the Finance Act, the effective date variation, which changed the effective date of the Finance Act 2023. Now, I remember that there's a case between the Federal High Court in the case of Lake Oil, which ruled where the Federal High Court ruled in 2019 that an executive order cannot change the provision of the law. What are your thoughts on the executive order signed by the president changing the effective date from May 1st or 28th, as it may be, to September 1st? I know it was they're trying to align it in line with the national tax policy, which states that about 90 days notice should be given. But do you think that the executive order signed by the president can change the effective date of the Finance Act, considering the Federal High Court, the Lake Oil case?
Okay, thank you, Ronke. So to this, I'll be a bit, I'll go down the legal route a bit because of my background as a lawyer and be a bit legalistic. So the way we have it in Nigeria is that there are three arms of government, each of them with their powers. So there is the National Assembly with the powers to make laws. There is the executive that implements, and the judiciaries that enforce those laws and compliance. So there's some strict dichotomy between all three as is enshrined in the Constitution, and that is what the the court tried to do in Lake's case, that if the law has said something has to be done, an executive order cannot change the law. But in this case, it is slightly different. If you look at the Finance Act itself, the commencement provision, it is wide enough to say it will be effective on the date that is written on it, which is 1st May, or on such other date as the National Assembly may prescribe, or as the President may prescribe on assent or by order. So that or by order is one area that we can, that the President, I would believe, has relied on to say, oh, this is an order that says this can come in effect at a particular date. So the executive order to vary the effective date of the Finance Act is actually in order in line with the Finance Act itself. So that is, but the practical reality of the extension are some of the things that may come to light. So some parties, especially on the filing dates, 14th, 24th, some of might have to change their platforms, comply, or some other things. But be that as it may, I suppose it's a welcome development for all parties as it impacts the, for example, the investment allowances. So assets incurred from June to September now can still participate and still enjoy investment allowance pending its removal subsequently.
Thank you very much for that contribution. Dr. Titi, my next to you. I remember Dr. Mukta also touched, and you also touched in the course of your general, when you're making your general comment about the removal of investment allowance. What do you think is the impact of this really in the manufacturing sector, considering that there's a lot of huge capital investment that goes in that space? So how do you think that would affect the business decisions of companies operating in the manufacturing sector going forward?
Thank you, Ronke. I think this is going to be a big hit on the manufacturing sector because knowing fully well that plant and machinery seems to carry the weight in the investment for that sector. This would require some strategizing in terms of our investment planning. Because what that means is that those tax attributes that we would have used for tax planning is withdrawn, because this will affect the effective tax rate for any manufacturing sector. And that means, and the industry is not doing that fantastic when you talk about exchange rates challenges that we are having now. We have things around the cost of running the business. And then this coming in now means that there's going to be a big chunk on the cost side for the manufacturing setup. So this is going to be more of trying to now look at our investment profile and how do we take best advantage. Apart from the accelerated capital allowance, it means we don't have any other thing we can actually make use of. And this means that we have to now start looking at, we can't stop having machinery, definitely. But if you look at the impact of this, whatever cost is going up in the manufacturing, do you know where it stands? It's going to sit in the prices eventually. And that means the consumers are going to feel the heat. So and we have not even talked about the fact that we now have education tax again, that is increasing. And you can imagine when you're talking about 0.5% of accessible profit, not even taxable profit, that's also a huge amount. So all these are going to affect the cost of doing business within the sector. And it's going to indirectly go and sit in the prices. And that means there'll be a very big struggle for getting market share, a struggle for staying in the market, because when prices are too high, then the purchasing power of the citizens is what you now start looking at. Now, can you now go down? Can you reduce your prices? Then you also look at competition. So manufacturing industry we now have to go back to the drawing board, do a lot of strategy review and see how that can they stay above board, how can they stay above the waters with this incentive that have been withdrawn, because it's a huge chunk that's going to affect the industry. Investment planning also, we can't do without machineries, we cannot. And so that means that those benefits we get, then it's going to be that. Then we have to start thinking of what are the best alternative. Like I said, it's going to be a very interesting time for the tax department to start thinking, what else can we do? How best can we leverage or manage or survive in the midst of the withdrawal of this incentive? It's going to be a very strategy shift for most of the manufacturing industries.
All right.
Thank you.
Thank you very much, Dr. Titi. You did mention that this would have impacts, of course, on the consumers. And we already know what is going on, right, in the economy, where the purchasing power of an average consumer has really gone down. Are there any discussions with the Manufacturing Association of Nigeria, to take up the discussion as an industry to see how maybe in the next Finance Act, if there could be changes to that? Are there discussions around that, since that is a major pain point for manufacturers as they speak?
Well, I know that this act is new. It's just a month old, and the Manufacturing Association of Nigeria has reacted to it. I know there are discussions going on. That has not been taken forward. I know very soon we would have to collate the impact of the Finance Act, and in the engagement between the Manufacturing Association and the government, this will be part of it. I know it's not only Manufacturing Association, NECA is also one of the bodies that are also looking into what is happening in the Finance Act. How does it impact on businesses? And for your information, engagement continues, because I remember when we had the initial Finance Act that impacted on the industry, there were engagements that came up with some other consideration. And with this one, there's going to be a major chunk of what the manufacturers would want to usually benefit from. There would also be engagement. And I'm very sure that with the rate in which the current administration responds to things that are happening, we would surely be able to get some listening to the pains of the industry, because without the manufacturing industry thriving, then we can't be talking about relying on our own products, because we still have to keep pushing it out. And we want to talk about even having export. If we manufacture enough that we can saturate the Nigerian economy, then we can start talking about export to Africa. If we're trying to say, okay, let's limit our importation to Africa, how can we even benefit from all the things we manufacture, push it to the African market, have some leverage on this. And I want to believe that this is also what Africa Continental Free Trade Agreement is supposed to achieve for us. So the conversation will continue, and I know very soon all this will be articulated and will be taken care of at the engagement with the government. Thank you.
Thank you very much, Dr. Titi, for that contribution. My next question will go to Mr. Pascal. For the oil and gas, those companies operating in the upstream and the midstream gas operations, in the course of your general overview statement, you also did mention that the restriction in terms of capital allowance claim has been removed. That means companies operating in that sector can now claim their full capital allowance without any restriction of 66 to third. Mr. Pascal, in your view, what would you say is the impact of this removal on those operating in the industry? Is it going to guarantee a level playing ground for the industry in terms of their cash flow management? And secondly, with the removal of this restriction, motivate oil and gas companies to unbundle their operations in line with the provisions of the Petroleum Industry Act to maximize their CAPEX incentives?
Thanks a lot, Ronke. Thank you very much for this question. Capital allowance to the oil and gas industries is very important. The oil and gas industry is heavily capital intensive, and it was really challenging to see that we cannot get the relief that is required at the right time also. The removal of capital allowance restriction for CETA purposes is a very welcome development, and it further emphasizes the point that the regulators are listening, because this came off complaints that we had from the previous act. So this is welcome, and it gives some reassurance that even the ones that have not been addressed will eventually be addressed. However, comparing the capital allowance restriction of 65%, the CPR restriction of 45% of revenue less royalty, to the removal of the CPR restriction, I mean the cost price ratio restriction of 65%, to the capital allowance restriction does not guarantee level playing ground at all. We know that the intentions for the CPRO was really to deal with efficiency in expenditure. So there's this view that the operators need to be efficient in their expenditure. And we kind of struggle a lot when we do some, a comparison without going into the peculiarities of our environment. We need to know that Nigeria has some different peculiarities. I'll give you an instance. The UOC for onshore Nigeria averages about $15 to $20 per barrel just to produce UOC, unit operating cost. If you look at this against what happens in other parts of the world, it's very high. And then what are the reasons? You will see that the inefficiency in quote is not coming from the operators. It's coming from the additional cost elements that come from the Nigerian environment. For instance, you have big security costs that is sitting on the oil and gas and companies. Just to mention a few. We also have the theft issue, because efficiency is, the way it's being looked at is looked at from two lenses, either the cost side or the revenue side. So you see that even from the revenue side, when you have theft of these oil produce, you lost revenue, and that is usually significant. You know what happened last year, and what the industry had to go through as a result of that. So the Nigerian economy has also experienced high inflationary pressure. You also know that from some reports, inflation is projected to be around 30% in this year. So that also drives cost, and these are things that have direct impact on efficiency. In addition to the cost price ratio restriction, we also know that the basis for the cost price ratio restriction, which is revenue less royalty, is completely different from the capital allowance restriction, which is based on accessible profit, which is profit after deductions of allowable cost. Again, we need to take a step back and say, the bases are different. There are situations where a company that is loss-making at a bidder level may still have to pay tax, have accessible or tax payable under the hydrocarbon tax, because the costs have been fenced at a certain level, which is 65% of the CPRO, of the cost price ratio, while 35% of the revenue is exposed to hydrocarbon tax after production allowance and royalty deductions, which impacts on cash flow. If we put all this in context, the cost that we carry forward under the hydrocarbon tax for future use excludes certain important elements. There are some peculiarities around the oil and gas in industry, which we need to note. For instance, in Nigeria, most of the indigenous went into this investment with leverage. So they are highly leveraged. So, there's that interest cost, which they owe to the financial institutions, which they need to pay. We have head office costs. We also have valid operational costs, which are not really taken care of in this provision. This buttresses the view that the removal of the capital allowance restriction does not create a level playing ground, like you will see in the agricultural and the manufacturing sector. So if you compare them, you see that there are different unique circumstances in this industry, and you can't just do a blanket comparison of the impact. Nevertheless, we'll say that it's a welcome development. As investment models today, we show that there are better results as a result of the early cash flow benefit from the time value of money model when compared to the rules that existed before this amendment. So what we are saying is that if you look at the relief that you get on the capital allowance today, if you put it in your investment model, because you can have a higher relief if you have accessible profit in the early years, it will improve the economics on the investment model, which is a good thing because this ultimately will bring investment into the market. But it is important to note that investment will come. The government, they are taking this action, but the right environment needs to be created. Every investment that comes and, for instance, experience the sort of conditions we had last year will not be smiling. For instance, when you have a theft. So government need to do more in terms of making sure that the environment is secured so that production can go continuously. The oil and gas industry thrive on continuous production. They produce every day. It's one industry that works 24/7, 365 days, right? Production is on a continuum. So every disruption to do that process increases costs, reduces revenue, and then creates, a situation that is not good for the investment. So beyond these capital allowance restriction, beyond the cost price ratio, we need to see that government pay bigger attention to issues around enabling environment so that, these benefits can be realized, and we'll see a monetization of the oil in the ground, which will translate into better prosperity for both the Nigerian state and even the investors. Thank you.
Thank you very much, Mr. Pascal. And I'm sure our new, government president and the current administration will have, they are paying listening ears to all the complaints in the different sector, and we hope, especially for the oil and gas sector, we are seeing, there has been some news that he has given, orders in terms of beefing up security where you have oil rigs. Let's just see how that turns out. And I'm sure in your own industry space also, there's a lot of conversation around how that can help the companies in the oil and gas sector, because also that sector, like you said, is very key and germane to the economy, and it would also help our revenue generation if all these little issues are, not little issues, so to speak, if all these issues in terms of the security challenge, the oil theft, is fixed, it would also help us. Like we currently know, we have a deficit budget, and the government is on increased revenue drive. So I'm sure all these complaints, all these things we are, making known to them, they would also want to work on it to help the revenue generation of the country. Thank you very much, Mr. Pascal, for that contribution. Mr. Mukhtar, the financial service sector is not left out. We've seen the inclusion of digital assets as part of the chargeable assets, and like you mentioned, and one of the earlier presenters mentioned, that the gains from these assets now will be chargeable to capital gains tax at 10%. What is your take on the taxation of these digital assets? Do you foresee any implementation challenges regarding the taxation of this digital asset? And more so, I know you being in the banking sector, right? The CBN, as I don't know right now, maybe you could also guide us in that respect. If there's been any guideline in terms of the CBN's view in terms of the digital asset. I know SEC has issued, their guidelines upfront as to how the regulations on digital assets. So what's your view on the implementation of the including digital asset as part of chargeable asset? What's your view on that? And has CBN come up with any regulation or guideline, or what do you think their feel is? Because now you can see that the government on one hand is trying to see they are trying to improve the revenue generation. So chargeable asset now has been included. Digital asset now has been included. So that means they want to get more revenue from that. So what's your own take on that?
Thank you very much, Ronke. Let me put some few comments on the initial topics around investment allowance. Then I'll come to how I think that should also be important to the banking sector. Then I'll come to the digital assets. Okay, so I know we have discussed extensively on investment allowance and capital allowance for the oil and gas, right? So if we put all these things together, these are important incentives that we need to give. And as Pascal has mentioned, You don't have to do blanket incentive. As a country, we have to start looking at our sectors separately in different buckets and look at the uniqueness of each sector and make rules, tax rules that fit that sector. Now the government say we've passed laws that would open up the power sector. You expect people to come and invest in the generation of power, transmission, and distribution. What incentives are you giving them? It can't just be blanket incentive. We need to look at what is the unique need for that sector. When you go to the oil and gas, you have given something, capital allowance. You can claim capital allowance that didn't used to be there. But is it a blanket capital allowance that that sector needs, right? If you don't have the right incentive for a sector, there is no investor that will invest in that sector. And the president has said in his inaugural speech that his administration would encourage investment and ensure that investors reap the dividend of their investments. So you need to get in the investors first, and you need to look at the sectors as specialized sectors and give them the incentives they need. The manufacturing sector, for example, if we want to encourage local consumption, you can only do that when the price of the locally produced goods is reasonable and comparable to the imported ones. When you get to the point that prices of locally produced goods, locally manufactured goods are more expensive than the imported goods because of our cost structure, because of multiple tariffs, or because of logistics, then you can't even sell what you are producing here locally. Then the issue of exporting has not come because you cannot even export at all. Your price, you cannot be competitive to export, whether to African countries or to other countries. So for me, that is very important. That brings me now to the banking sector. The financial services sector has to be looked at as a specialized sector. We're talking of capital allowance, investment allowance in different sectors. The banking sector today is heavily dependent on technology. We invest significantly in technology. Now, brick and mortar banking hub is no longer in vogue. We are operating within the digital space. And when you look at the balance sheet of every bank, you see significant investment in technology. I know that Nigerians know what it takes, what it means if the whole banking platform goes down. At least we have tasted it. The government has tasted it. So we know what it means for banks not to go down. So it means the banks have to continuously invest in technology to enable us to continue running 24/7. That's number one. Number two, we also know what it is if a bank or the banking sector says that our websites, our platforms have been hacked. We know what it means to your money in the banking system. So cybercrime is very real. So banks invest a lot within cybersecurity. So for us to continue to do that, the tax rules have to look at some incentive for us. I will advocate for the tax rules to look at technology incentives because that is very critical for us. As investment allowance is critical for the manufacturing sector, I think technology allowance should be considered for the banking sector and maybe the telecoms, the telcos. The telcos also do significant investment in technology. And this technology, as it is today, is so dynamic. When you invest in something today, it doesn't take 3 years. Within 6 months, 9 months, 1 year, it's gone. A new model has come. You have to reinvest. So we need something that looks like a technology allowance or something of that sort to recognize the fact that we need to spend a lot of cash in getting this technology. And we need to protect that technology by investing again in cybersecurity, right? So that is what I would really advocate for the banking sector. Then you mentioned the issue of digital assets. We first of all, as a country, have to have a proper and unambiguous definition of what we call digital assets. The kind of product that we think fall within that definition of digital assets, and whether we think those digital assets are legal or illegal. We can't have one government agency saying it's illegal and another government agency saying it's legal and another government agency saying we are going to tax whatever capital gain you make from it. We need to be very clear. Do we think it's an asset? Do we think it's legal? So that we can get the framework. But when we treat those that deal in those assets as breaking the law or criminals, and then we now say we want to tax their proceeds, it's a bit confusing. But what they have here now is to say that when you trade on those assets, the capital gains you make from it, we're going to tax. It's going to be very difficult, especially when the trading is done by individuals. If it is a company, you probably see it on their balance sheets, and then you probably see the movement and be able to track the capital gains and be able to tax it. But when you have a lot of individuals are trading on crypto, they are doing it as individuals. How do you tax it? It's going to be difficult for you to do. But if you have a proper framework, digital assets, what kind of bank accounts can you use to trade on digital assets? The sector can designate a way that we can track who is trading on digital assets and who is not trading on digital assets. That helps to do the taxation properly. Thank you.
Thank you very much, Dr. Mutal, for that insightful conversation. So you made two comments which really sticks out for me. One is in terms of, having to look at industries, incentives for industries and not just general incentives. And in terms of heavy investment in technology, that the government should look into that. And I'm sure, as the Finance Act is a yearly thing, these are things that should be looked into to modify or include that in subsequent Finance Act. But one interesting thing that you said is, one arm of the government looking at the legality of digital asset, another arm of the government is saying, no, it's not, legal. Ashata, being a legal person, does taxation follow legality or illegal legality?
Well, so I typically say the taxman. I liken them to the people at the bus parks, the people that were popularly known as the agberos. So, and their slang is just give me my own. So the taxman is more or less wherever money goes, I'm present. There's money here, they sniff it and they want to collect it. The tax law is primarily not linked, they're not concerned about legality or illegality of income. So long as there's proceeds, so long as there's funds, they would want to look into it and tax it. So I think that's the major primary aspect of this one. But as Dr. Mukhtar mentioned, the practicality, the feasibility of it is a key aspect that needs to be keyed into before. We don't want to just have laws that cannot be enforced. We don't want to have laws for just having law's sake. So it's good that and it also helps the narrative where we have a cohesive approach by all the regulators and all the people dealing with it. So if we say one agency says it's this, the other agency says it's that. So if you look at the Finance Act, it says digital assets. Where do we go to it? Okay, you can go to SEC, but other people would want to argue otherwise. So to leave room to reduce or minimize incidences of challenges here and there, it's better, as Dr. Mukhtar mentioned, to have a cohesive approach as a nation to deal with it. Do we want it? Yes. Do we not want it? No. And again, to add onto this, one of the things where I know that in the past couple of years there was a boom of the digital assets, and then there was a dip. So the DIP has generated losses. So with the introduction of deductibility of losses and the Finance Act, one area that would maybe people would want to say, okay, let me subject myself to the tax net because I want to be able to claim the losses that have at least that has been incurred on these digital assets over the years. But the caveat that the Finance Act has brought is that the loss can only be in relation to the same category of assets. So in the past that these have not been taxed, the losses that have been incurred to cannot be brought to be relieved going forward. But on the classes of assets that the Finance Act brought into, I think there will be need, maybe in subsequent Finance Acts, to expand what the categories of assets will be. I know that there's been categories of assets in other sections of the Capital Gains Tax Act, but it will be useful to say, okay, do we say all PPEs are one category of assets, or you say this machinery is one, or this one, or do we say all the assets that the company uses are one category of assets in production, or you say, oh, building is separate from the machinery. So these are some of the things that will come to light as we go ahead.
Thank you very much, Ashata, for that contribution. And thank you once again, Dr. Mukhtar, for that insightful contribution. So if you look at the Finance Act 2023, it mandates the regulatory agencies in the shipping and air transport sectors to request for income tax filing antithesis from companies taxable under Section 14 of the Companies Income Tax Act before they can obtain approvals or continue their transportation business operations in Nigeria. Ashata, how feasible do you think the enforcement of these requirements would be?
This is a new provision, and I think the shipping industry has witnessed a shake-up as they have never witnessed in the Nigerian sector in the past couple of weeks. But to address this question and to put it in perspective, I would say there are two issues or two highlights that I'd like to bring up from it. So there is one that talks about the taxable person, where someone is taxable. So the question is determining who is taxable in the international transport industry. So for airline, maybe a bit straightforward because the carriage is mainly for passengers and then for persons, and it's pretty straightforward. Airlines are registered amongst other things, and there are not as many as you would have in the shipping industry. So in the shipping industries, there are the charterers, there are the owners. Determining who is taxable is one major aspect that needs to be clarified, which is the basis of the issues that we've had in the sector in recent times. So there's that aspect. So determining who, and then because we have to determine who is taxable before we now go into filing and obtaining TCCs. So that is on one hand. On the other hand, the feasibility of getting preparing returns before you are given license or permits to operate in the sector, it's a bit it's like a chicken and egg, because one, the way the law is drafted envisages that there will be accounting done on an annual basis, like voyage accounting for the shipping industry, and then for the airline they would have their own accounting, taking into consideration the income, which is like the freight income or passenger income or primage as the case may be, and then the expense, and including depreciation. You would note that one of the introduction of the Finance Act 2023 itself is that they need accounts that is signed off by an auditor and all of that. So if that is a condition to actually get permits to come to the country, and you have not done it, it's standing a bit on its head. So we know that there are procedures to get information across to the Nigerian Ports Authority, to NIMASA, to get that, and to the Customs Authority to get things sorted before the ships actually berth. Yes, that is understandable. But to actually have financials certified by third parties at that point may be a bit tough. Same thing with the tax clearance certificates. So there are ships that come to Nigeria once. There are ships that do not even have that the owners are dealing with charterers, and the charterers or the ship owners are in a consortium. So that in determining who is the taxable person, those are practical realities that needs to be focused on. And then getting financials it's like getting financials for a company that has not completed its period. So these are major critical ones. To make it easier, because I know that the tax authorities and the Nigerian government wants to say, okay, there's an income being made here, there should be income tax. There can be maybe easier ways that would make the administration easier and make compliance much more better, because we all know that voluntary compliance is the best form of compliance. Chasing after people after the fact takes a lot of time and energy and funds from the Nigerian government. So if we make it easier, it can be better. So it could be, there's provision for minimum tax there, which is 2%, or a little bit higher can be a form of withholding tax that can be filed on whatever it is that is deferred income. And if companies choose to file their accounts and claim, if they think that amount is higher, they can file and claim it subsequently, have that when their accounts are ready. But we can have a framework to have the withholding or some form of filing on any voyage filed. So irrespective of who is paying it or where it's coming from, if it is filed as a precondition, it makes it easier and make the administration easier. But having financial statements before completion of voyage or before completion of carriage of goods outside of Nigeria may be difficult. Again, we are saying we were open to the world. Do you want companies, do you want shipping and airline companies to be the ones that have always been in Nigeria to be the only ones that would continue coming? Because those ones have a track record. If you want new bees, if you want to open to the world and you have a precondition to file tax returns on a voyage that has not been completed, it may be difficult. So we need to look at it and make a cohesive approach as a nation.
Thank you very much, Ashata. I totally agree with you that all those modalities need to be looked into so that we can encourage business in that space and not stifle their operations. So, thank you very much. So, Dr. Titi, in the course of your conversation, you did mention also that that an additional levy of about 0.5% from whatever good is imported outside Africa. How do you think that would affect your supply chain strategy going forward?
Okay, thank you, Ronke. Before I go into that, I just want to say a bit about the shipping, because as Isata was talking, I started thinking about manufacturing sector. Because when you import your raw materials, and these ships are going to have this like a bottleneck to their being able to bring in the raw materials to Nigeria, so it's going to really affect the cost, because they look at all the inconveniences they're going to have. They would want to look for a way. Is it that they say we're not going to Nigeria if they can't meet up with this, or they do what is required, and then you've got to have some things in terms of your shipping costs. So this also adds to what we're also talking about. You have your investment allowance. You are now having the shipping industry that are now having this sort of bottleneck, which is not well defined for them. So that's another impact on the manufacturing sector. Now, coming to this other levy they're going to have because they're importing, there are critical questions to ask ourselves. If we have to go and import outside Africa, why? It's because we would have looked at it. Is it cheaper? Are we getting the right quality? Are we able to have access to finance? Because there are some of these things that has to do with you getting finance to be able to get these things from the international market. And the access to finance is not as easy as what it's not like the one you have in Nigeria here. So in terms of this is more of a disincentive for you to get your raw materials from other locations. And the question we're asking ourselves is also that, can you really get this thing from Africa? If I can get from Africa, why will I want to go outside Africa? Now, if I can get from Africa at a rate that is competitive, I will not push up the cost, my cost, because I'm as a business owner, we're looking at the margins. We are looking at being able to give returns to our investors. So the more your margin gets thinner, the lower the return, the more the investors will start complaining. And you need these investors for you to be able to run your business. So it's something that's going to affect the supply chain strategy, definitely. Because if you're going to have higher costs, getting it from outside Africa, then the question is, what alternative do you have? And these are part of the things that I know and I believe that the Manufacturing Association is going to take up and look at. Do we have a comparable. For instance, let's take gypsum. Where in Africa can you get gypsum that is a quantity that will be useful for those who are in? You have to look at that, because you have to also look at that quality. Then what is the quality that you can get? And you also have to look at the quality of the product you want to put into the market. So if you're getting raw material that will not give you good products, then you're going to run out of competition, and you want to have competitive products. So this, I think, is something that would affect the manufacturing industry seriously, unless we are having a means of creating that source within Africa and at a competitive rate, such that the cost is not over bloated and that we are not already adding more pain to the consumers that we already know that they are going through a lot. So this is an area that we feel it's not so good for the industry. It's something that would push up costs if we're not careful. And when we are talking about our value supply chain, we would now have to start looking at where else, and that's a big problem. Where else can you get this? You cannot just get these things with your own funds. Now, let's look at the problem we are having with foreign exchange alignment, or whatever we call it now. You're struggling to get these effects. You need to bring in your raw materials, your production, your stock level, inventory level is low. And you're struggling to get effects from the Nigerian market. The cost is on the high side. But you're able to get an external finance at a lower interest rate that will help you to bring in these things. Or you're able to get support from an other continents. Will you now say because you have a restriction, you will not go for that? Then these are areas that needs to be looked into. It will impact on the manufacturing business and any business that relies on importation. Even though we are trying to encourage, trying to do more, create our local goods and become an export-oriented company, but we have to start from somewhere. We need to have that resources. We need to have that framework, that environment that will help us to be able to run within the African environment. I'm still asking a question that where can we get the right quality and the right quantity of these raw materials within Africa and at a competitive price? That's a major challenge. Thank you.
Thank you very much, Dr. Titi. You did mention that maybe we need to start looking inwards also in terms of the value chain. But don't you think with this introduction, maybe companies in the manufacturing sector should also start looking at like backward integration strategy, or what's your take on that?
Yeah, I think this will push us to start thinking. I used to say you have to think outside the box anyway. As much as possible. It will push us to start looking at backward integration. I know some companies, some manufacturing companies has already started looking into that, but we still need to talk about the cost and ease of doing business within Nigeria, because it's important. If you want to go into backward integration, I'm very optimistic that we're able to talk about the issues about insecurity that's going on. You want to go into let's assume you want to talk about backward integration for sugar, for instance. You need to have the space. You need to have the land. And even if you do backward integration, some of these things that
all right. I think we lost Dr. Titi. Thank you very much.
At least you need machinery. So it's something that will force us to look back. Thank you.
Hello, Dr. Titi.
Yeah. Can you hear me?
Yes, we can.
Okay.
All right. Thank you very much for that contribution. I'm sure it's something everyone will want to look into in terms of backward integration if the right things are put in place, in the country. Thank you very much once again for that insightful contribution. My next question will go to Mr. Pascal. We are aware that the PPTA has been amended to treat decommissioning and abandonment cost as deductible for tax purpose. In your view, does this indirectly confirm the provision of the Petroleum Industry Act, which requires every licensee to set up and manage a decommissioning and abandonment fund?
Yeah, thanks. Okay, this is a big one for the industry because the decommission and abandonment cost is it is a huge cost, and then it also speaks to the fact that there are some elements around the sinking fund that will be created. This question further emphasizes the practical issues that we have in the industry. The commissioning and abandonment cost is real. These oil and gas companies are producing, and definitely there will be an end life to this production, and then there will be actions that will be taken for restoration. The question further emphasized the practical issues that we're facing. I just quickly speak to the section 3233 of the PIA mandates each lessee and licensee to set up, maintain, and manage a decommissioning and abandonment fund. And so this is clear from the Act. Section 318 defines a lessee as the holder of a lease, and a lease as a petroleum mining lease. It's the reason why I'm giving this background, because there are some conflicting positions. If you go with this, there's an issue of whether the decommissioning and abandonment rules applies to existing oil mining lease holder, and if these holders do not convert to petroleum mining lease, where does it leave them? Section 303 further buttresses the point that the provision of the PIA shall apply to holders of an oil prospecting license or oil mining lease who do not enter a conversion contract. The PIA shall not apply to these licensee who do not enter into a conversion contract. So if you hold the thought there, then what really will we get from this? We know that there are gray areas, and these gray areas need to be cleared. We need clarity in these areas. However, we also know that from the engagements we've had with the regulators, the intention of the regulator is to get all of these operators to set up this fund. And it's very important. And like I said earlier, this fund will be used for remediation. When we reach the end life of production, it will happen someday. This won't continue until eternity. So what then happened to those environments? They need to be restored to their original form, or some form that makes it good for lives to go on there on a normal basis. In addition, there have been several engagements we've had with regulators, and they've been focused on the broad subject of decommissioning and abandonment fund. And these also show that they will not be restricted to the type of license that we see. This is important, and because globally you will see that there's some real focus on ESG. ESG is critical to investment. Environmental, social, and governance is critical to investment, and this also tie up to decommissioning and abandonment. One key element to state is that this, whereas we are struggling with clarity, and clarity will come, I think there will be guidelines and regulations that will provide the clarity that are required. But if we look at the economic implication, one clarity that is being sought is, where would this fund be domiciled? Will it be in Nigeria, or will it be abroad? Industry players have said this fund should be, or key industry players are pushing that this fund be domiciled in Nigeria for many reasons. It will strengthen even the FS liquidity supply. It will lead to capital formation. It will strengthen the banks, because these funds will be in Nigeria banks. It will, create the funding bill that is required even by the government to undertake other key activities. So it is a key provision in the Act, and we are all set up to have this fund. There's been several engagements that we are having to set up the funds and to make sure that the funds are working as desired. We are waiting for those clarifications that I talked about. But overall, these funds will be important to show good intent, even to the international community, that we are focused on ESG. ESG is a key concept that drives investment even in different markets today. And there are some investors that will go to a certain country or certain investment class if they are not ESG compliant, right? So we think that is a good step in the right direction. The funds will be created, and then it will also galvanize certain qualifying investment that we need in the Nigerian space. Overall, good plan. Thank you.
Thank you. Yes, thank you very much, Mr. Pascal, for your contribution. There are some questions that have been dropped in the Q&A box, and I would like us to quickly take one or two questions before our time is up. And one question is that, yeah, you know that there are yearly amendments to the Finance Act, and the question by Obi Anoye says that should organizations start, planning in the long term, or should they do short-term planning, since there are amendments to the Finance Act, and there are certainty also around, the amendments to be included in the Finance Act. So what should organizations do in terms of strategic planning? Dr. Mukhtar, I don't know if you could give us your thoughts on that.
Okay, thank you very much. The whole concept and idea of strategic planning has moved from long-term planning. You can have long-term vision, is what you want to achieve in a broader perspective in the long term, but the planning is every day. So if you look at the banking space, our customers, our review on our social media handles on a daily basis determines how we wake up the following day, determines the new product you're going to launch in the next month. So when you go for your strategic planning, you are planning the vision. Okay, so what really do we want to do? What do we aspire to do in the next 2 years, the next 3 years, or the next 1 year? But the market changes on a daily basis, and that means you have to be very dynamic. So everything we're talking about is dynamic. If the operating environment is so dynamic, the policies and the tax rules have to match that level of dynamism. So you will plan based on what you have on ground. And you also have some comments or some wishes, and then you do scenario planning. So in addition to your strategic planning, companies now do more scenario planning. You have scenario A, B, C, D, depending on how far you want to go. So the key word here in running a business is dynamism. Everything is dynamic. So that's how I want to respond to that.
Thank you very much, Dr. Mukhtar. I like the way you said that, yes, you definitely have long-term strategic goal, but in this ever-changing world, you need to also be very dynamic. You can't afford to remain static to say, I have this goal and I'm not going to, change. You need to move with the changes going on, whether in the tax space, whether in the regulatory, even in our personal lives. You have to be dynamic and update your goals as the situation warrants. The next question is by Arinze Jacob, that with the increment in the tertiary education tax from 2.5 to 3%, and the government is also trying to make the tertiary education institutions autonomous, and that's why the introduction of the student loan. The question goes forth. So what would the revenue, the tertiary education fund, be used for? Any of the panelists could help us with that?
Let me make an attempt to talk before any other person talks. My understanding is that the tertiary education is supposed to be used to take care of our tertiary institutions. So I'm actually surprised that that question is coming, but that's the objective of that. But you see, we need to also remember that we need to be accountable. The day we see the financial statement of Tertiary Education Trust Fund published, saying that this is what they've collected, these are the schools they have used it to work with, these are the amenities that are put in those schools, these are the blocks they have built, these are the students that have been sponsored, then we know we are getting to somewhere. So when we have all these funds going in and there's no accountability, there's no transparency, we can't hold somebody to it, then we really don't need a student loan if these things are done properly. I think education can be made as easy for students as possible with all the education tax that we are paying. I look at this, education tax is a percentage of accessible profits. It is not the bottom line, it is the up line. And if this money are contributed and we are not just leaving it there without somebody accountable for how it is spent, then we'll still be talking about student loan. So if we actually get it right, I am not against the student loan anyway, but I'm saying somebody who has eaten well is the one that will be able to take loan and pay back. So how will we collect the student loans? These students are still struggling, their parents are struggling. How are they going to be able to pay back? But I want to believe that education loan should be properly structured. When it is collected, we have how many number of schools, we have how many number of facilities that require renovation, we have a number of students that could not pay for their school fees, and then let us know what this is used for. And this is part of what companies are contributing to the development of education in this nation. I think we need to change this education tax, National Education Tax Fund modalities. We need to change it so that we can meet the need of students. We don't want students back home. We don't want us to strike again. But let them have a strategy around this education tax, and we don't have to start talking about student loan if this is properly administered. Thank you.
Thank you very much, Dr. Titi. Your keyword accountability is very key. Okay, Mr. Pascal, over to you.
Okay, thanks. I just took a stab at it, and I'll be very quick for time. I agree with Dr. Titi. They need to be accountable. We need to see how the funds are being utilized, and perhaps when that happens, we will see that there's still a funding gap. To say that the institutions are going to be autonomous means quite a lot. If we go into looking at the fund that is required for running this institution, we'll see that it's huge. So particularly in the transitioning period, even when they make those institutions autonomous today, we'll see that there's still a funding gap, which is what this educational tax should be used to bridge the gap. And then, of course, structure is built that helps to get into the next phase for giving out the loans, and then ensuring that the economy is buoyant so that the loans can be paid back. You know, in other economies where this is done, the economy is buoyant so that when the beneficiaries of this loan come out of schools, they get into paid jobs, and then they are able to generate the revenues that are required to pay back this loan. But we know what has happened in our economy in the recent past. So these things need to be complementary. It needs to be tied up in such a way that it works together to deliver the desired outcome. Thank you.
Thank you very much, Mr. Pascal. And wow, it's been a very, very enlightening session. I don't feel like ending the session, but of course we all have to go back to our various workspace, you know, to make more money and pay taxes to the government. On behalf of Yomi Olugbenro, who is the host of this event, and our other partners in Deloitte, we would like to appreciate our panelists for taking out time out of their busy schedule. I know how Dr. Titi could be very, very, very busy. She's up and about, but we want to sincerely appreciate her for agreeing to be part of this panel session. We would also like to thank Dr. Mukhtar Adam. Thank you for participating. Thank you for giving us, over 2 hours of your time. Being the CFO of a very top bank, we know what it is to get you out of your space for 2 hours. We sincerely appreciate this, and we do not take it for granted. Mr. Pascal Eva, we want to say a very big thank you to the oil mogul. Thank you for taking out time, for accepting to be part of our panel session. Thank you very much. And to Ashata, I hope you won't bill us for this session. Thank you. Thank you very much for your insightful contributions during this session. Thank you very much. And to our amazing participants that have stayed throughout the webinar, I'm sure we all have key takeaways from this webinar. We want to say a very big thank you for your time. Thank you for joining this webinar. We have some upcoming events in Deloitte as displayed on the screen. Please feel free to reach out to us. Our doors are open to provide any necessary assistance or guidance regarding the things we've discussed in this Finance Act. Our doors are all open. We want to say a very, very big thank you to everyone that has participated. And also we hope to see, more better changes, in the Finance Act that would speak to some of the valuable contributions that have been made by the panelists here in terms of, being more accountable, like Dr. Titi has said, for the tertiary education fund bits. I'm sure most companies, even Mr. Mukhtar, when he's paying those huge liabilities to the government, I'm sure he's looking at it. I'm paying 2% of my accessible profits. All companies are looking at it. Government needs to be more accountable in terms of how those money are being spent or accounted for. And all other changes that we've seen here and there, we also encourage everyone, as companies, like Mr. Mukhtar said, Dr. Titi has also said, we need to be quite dynamic into how we run or plan our strategic business objectives. So we need to be more dynamic. We need to pay more attention to the ever-evolving changes in the regulatory space. And also for those in the oil and gas sector, I'm sure the government is also doing something in terms of security and theft challenges. So we'd like to say a very big thank you. And this webinar will be coming to an end. I think we've been able to save about 4 minutes of our time. So we'd say thank you very much. And we look forward to having you in our subsequent events and webinars. Thank you very much. Let's enjoy the rest of our day and have a fantastic weekend. Thank you.
Thank you very much.
Thank you. Thank you all.
Thank you, everyone.
Thank you. Have a lovely weekend.
Thank you. Thank you. Thank you.